guys, it's your boy Toby. Welcome to our course on Forex Trading. But then, first of all, we're going to be treating what is Forex. Now, somebody's going to be asking Forex, what's Forex or what's Forex all about? Now, here we're presenting a comprehensive Forex Trading tutorial. Introduction to Forex Trading complete course. Now, what is Forex? Forex simply means exchanging one currency to with another. As you could see over here, exchanging dollars for euros. Now, Forex stands for foreign exchange, which is exchanging one currency for another. You sell a currency and buy another currency. And once you do so, you've essentially involved yourself in the Forex market. In Forex trading terms, assuming that you're an American and you visit South Africa, which means you've sold dollar and then bought rands. If you're an American, you visit UK, you've sold dollar and then you bought pounds. Okay, the foreign exchange market known as FX is the largest financial market in the world. The foreign exchange market looks absolutely beautiful with its $4 trillion a day trade volume. Now, this is $4 trillion a day trade volume. This is the amount of money that goes into the foreign exchange markets on daily basis on the internet. Now, because you're not buying anything physical, sometimes this kind of trading could be very confusing. Now, think of buying a currency as buying a share in a particular country, like buying a stock of a company. Now, the price of the currency is a direct reflection of what the market that thinks about the current and future health of that country that you're going. And then, for instance, when buying the Great Britain pounds, you are basically buying a share in the British economy and you are betting that the economy is going to do well, isn't it? Okay. And will even get better as time goes through analyzing using basic methods. Now, since or once you sell those shares back to the market, hopefully you will end up with a profit. In general, the exchange rate of a currency versus another is a reflection of the condition of that country's economy compared to another country's economy. And then we're going to be treating major currencies traded. What are those major currencies traded? Now, if you look over here, you'll see United States dollar, you see euro, you see Japanese yen, you see Great Britain pounds, you see Switzerland francs. Here you see Canadian dollar. Here you see Australian dollar. You see New Zealand dollars. And then to all these currencies mentioned over here, we also have their nicknames, okay? And then the nickname for US dollar is actually called buck. Then the nickname for euro is fiber. The nickname for yen is same as yen. The nickname for pound is cable. The nickname for France is Swizzy. The nickname for Canadian dollar is Loonie. The nickname for Australian dollar is Aussie. Then the nickname for New Zealand dollar is Kiwi. Just like you know the Kiwi Polish. He said the symbols always have to them. Now these are supposed to have symbols, okay? But then the symbols has always always had to them three letters. The symbols have to them three letters, which signifies the first two letters specifies the name of the country, to which the third letter specifies the name of the country's currency. Now take USD for instance. The US represents United States and the D stands for dollar. Easy enough, right? Now the currencies includes in the charts or the currencies included in this trading platform, as you will see, are actually called the majors. They are determined as the major currency pairs that are traded in the world's global financial market. And then we're also going to be talking about leverage. Now, what is leverage? Leverage is borrowing money from the forex brokers so that you can get an even bigger exposure to the market. Now, you don't pay any interest in this loan or in the loan. So in forex trading, a small amount of deposit can control a much larger or large contract value. Okay, now leverage gives a trader the ability to make nice profit. It gives a trader the ability to make better profit and to keep risk capital to a minimum. Now with $100 you can handle a currency that's worth 1,000 US dollars. Now, e.g., let's say example, if you make 2% of that $1,000, that means you have made $20, and your trading account will become 120 US dollars. And we're also going to be talking about now, looking at the diagram here, you could see the effect of leverage. Now you have, let's say for instance, $100 here. You will be able um, to have the opportunity of trading with as much as this money, as I said, up to 1,000 US dollars. And then here it shows the same diagram here. You deposit $100, as little as $100, you're able to get up to 1,000 US dollars to make a better trading decisions and to make a better profit with your trading. And also we're going to be talking about leverage sizes. What are those leverage sizes? Now we have 1 is to 50, 1 is to 100, 1 is to 200, 1 is to 500, 1 is to 1,000. Now, for example, a forex broker may offer 1 to 50 leverage, which means that a $50 margin would enable a trader to buy or sell 2,500 worth of currencies. Similarly, with $500, one could trade with the amount 25,000 US dollars and so on. While this is all gravy, now let's remember that leverage is a double-edged sword. Without proper risk management, this kind of high degree of leverage could lead to large losses as well as gain. So it depends on how you manage your risk, how you set and or how you make your risk, how you take your risk management. And then when that is done, you will always end up making some attracting and appreciating profits. Okay, as a forex trader, all we have to also understand is that making good trading decisions matters a lot as a forex trader that is growing to build a career in this firm. And then you are probably wondering how a small investor like you and I could trade that large amount of money. Now think of a broker as, or think of your broker as a bank that basically borrows you 100,000 US dollars to buy currencies. All the banks ask is that you set aside the 1,000 US dollars as a good faith deposit, which they will hold for you but not necessarily keep. Now sounds too good to believe, right? Now this is how trading forex using leverage works. So most of the times you could actually negotiate with these brokers, and you may just want to tell them, okay, I have $1,000, how much are you guys going to give me? And then you select the leverage. If the leverage selected is allowed, automatically it will show in your trading account. But if not, they will not accept it, and that means that you have to select a lesser amount before you then get what you actually need to make this trading work for you. So the amount of leverage you use will depend on your broker and what you feel comfortable with. Typically, the broker will require a trade deposit, also known as account margin or initial margin. Once you have deposited your money, you will then be able to trade. Without money in your account, there is no way you can access this account. Okay, so the broker will also specify how much they require per position lot traded. Now, for example, if you uh, if the allowed leverage is 1 is to 100 or 1% of position required, and you wanted to trade a position of 100,000 US dollars, but you only have $5,000 in your trading account, no problem, as your broker will set aside a 1,000 US dollars as down payment or margin, and then let you borrow the rest, of course. And then any losses or gain will be deducted or added to your remaining cash balance in your own account. Now, the minimum security margin for each lot will vary from broker to broker. In the example above, the broker requires a 1% margin. This means that for every $100,000 traded, the broker wants 1,000 as a deposit on the position. Also, so we're going to be discussing a 24-hour market. What is a 24-hour market? Now, the forex market is a seamless 24-hour market. Most brokers are open from Sunday at 11 p.m. GMT until Friday at 11 p.m. GMT, with a customer service usually available 24/7, with the ability to trade during the US, Asian, and European markets hours. You can customize your own trading as well. So looking here, you see London, Tokyo, Sydney, New York, and Europe. So these are actually plugged into the forest market sections, and these times also are plugged into same trading system. And then we'll be talking again. The next subject is execution of market orders. What is an execution of market order? Traders are instantly actualized under usual market conditions. Under these conditions, usually the price shown when you execute your market order is the price you get. You are able to execute direct off real-time streaming prices. Many brokers only guarantee stop, limit, and entry orders under normal market conditions. Trading during a massive alliance inversion from outer space would not fall under normal market conditions. Now, fills are instantaneous most of the time, but under extraordinary volatile market conditions, like during Martin attack, other executions may experience delay. So why am I showing you this diagram? Now, talking about market executions, here you see over here at the top here, you see market execution, and then here I think we should be we should see something market execution, instant execution here. Now, this diagram here shows you how the system looks in your computer or in the system you're using. Either is a desktop you're using or computer or laptop, let's say. And then this shows you how it looks in your phone, in your Android phone. So if you want to execute a trade, market execution, as they have said, what you need to do, if you want to buy, you just hit here and then you're able to buy. If you want to sell, you just hit here and then you're able to sell. If you want to sell, you hit here in your system using your cursor to enter the trade, and then the market will be instantly executed. And then also, if you want to sell, if you want to buy here, you just hit here and then the market will be automatically executed. And then apart from that, we also have another topic that is called market structure. What is a market structure, guys? For the sake of comparison, let's first examine a market that you are probably familiar with, the stock market. These are the stock market. Over here you see what's going on here. See a lot of the market owners. These are market masters. We have a NAFDAC company here. So these are what I call market structures. These are all market structures. All these things you see here, market structures. As it said, this is how the structure of a stock market looks like. Now, by its very nature, the stock market tends to be very monopolistic. There is only one entity and one specialist that controls prices. Now, all trades must go through this specialist. Because of this, prices can easily be altered to benefit the specialist and not the trader. Now, how does this happen? In the stock market, the specialist is forced to fulfill the order of its client. Now, let's say the number of sellers suddenly exceed the number of buyers. The specialist, which is forced to fulfill the order of its client, the sellers in this case, is left with a bunch of stock that he cannot sell off the buyer's side. And then we also have some other subjects that will be treating this. Talked about how to read forex quotes, how to read forex quotes. If you see here, you could see now currencies are quoted in pairs. As you see here, Euro USD currencies are quoted in pairs such as Euro USD, USD JPY. Now the reason they are quoted in pairs is because in every foreign exchange transaction, you are simultaneously buying one currency and selling another. Now here is an example of a foreign currency exchange rate for British pounds. Foreign currency exchange rate for British pound. Now the British pound here, as you could see over here, this is the British pound. What the British pound gives. Okay, so this is the British pound. This is the price for British pound. Thing, yeah. So these are the prices. And each of these prices are determined to be bid, and then each is determined to be asked. So as you could see, you are simultaneously, anytime this happens now, in the foreign exchange market, whenever you see currency pairs quoted in this form, there are um, there are strategic there are most often pairs are interpreted in this form. It could be that it's not actually what you see here, Euro USD, but then it could be any of these pairs. But I bet you it's definitely what it means. That's what it means. Now here is an example of a foreign exchange rate for British pound, as you could see over here, and then the first listed currency to the left over here, they said the over here of this, to the left of the slash, is determined to be the base currency. It's known as the base currency. And then in this example, the British pound or the euro here, in this example, the euro here is the base currency. And then also we have some other ones. And when buying, the exchange rate tells you how much you have to pay in a unit of quotes currency to buy 1 unit of the base currency. And in the example above, you have to pay 1 point. Now in the example above, you have to pay 1.12042. You have to pay this amount of money to get 1 British pound. You have to pay this amount of money to get 1 British pound. So let's take, for instance, this is dollar and then this is euro. Let's just take for instance. So this is how reading forex market quote works. Now when selling, the exchange rate also tells you how many units of the quote currency you get for selling 1 unit of the base currency. Now in the example above, you will receive just like the same way I explained with the first diagram. That's how it works. Now the base currencies is the basis for the buy and then or the sell. Now if you buy Euro USD, this simply means that you are buying the base currency and simultaneously selling the quote currency. In a simple term, buy euro and sell USD. Buy euro and sell USD. Now you would buy the pair if you believe that the base currency will appreciate, gain value relative to the quote currency. You would sell the pair if you think the base currency will depreciate, lose value relative to the quote currency. Alright guys, so we just forge ahead again, and then we'll also be looking at a short and long or long short. What does it mean to say long short in forex trading? First, you should determine whether you want to buy or sell. If you want to buy, which actually means buy the base currency and sell the quote currency, You want the base currency to rise in value, and then you would sell it back at a higher price. In traded stock, this is called going long or taking a long position. Just remember long. Long means buy. That is what you see here. So long here, as you see this long, it says long means buy. If you want to sell, which actually means sell the base currency and then buy the quotes currency. You want the base currency to sorry, you want the base currency to fall in value, and then you would buy it back at a lower price. This is called going short or taking a short position. Just remember short. Short means sell. So all forex quotes are quoted with two prices. Forex quotes are quoted with two prices. If you open your chart right there, you would discover, if you open your MetaTrader 4 chart, you will discover that there is these two horizontal lines that moves with the candlesticks. There's just two horizontal lines that moves with the candlesticks. Those lines are actually determined to be called the price. And now the price or the bid is lower than the price. The price is at the top, and then the bid is the next. The bid is the price at which your broker is willing to buy the base currency in exchange for the quotes currency. This means the bid is the best available price at which you, the trader, will sell to the market. Now the ask price is the price. The ask price is the price at which your broker will sell the base currency in exchange for the quotes currency. This means the ask price is the best available price at which you would buy from the market. Another word for ask price is offer price. Now the difference between the bid and the ask price is popularly known as spread. So it's popularly known as spread. Now, how do you identify spread? Now, looking at the price there in your MetaTrader 4, as you download it, looking at the price over there, one thing you will notice very well is this. Now, all you do for me is that you please look very well. You see that in between those two prices, the bid and the ask, there is a space in between them. That is what is determined to be known as spread. Now on the Euro USD quote above that you saw, on the Euro USD quote, now the bid price is, let's take for instance the bid price is so and so. Let's take for instance the bid price is let's say 1.12042. Okay, or let's say the bid price is 1.34588. Now the broker makes it so easy for you to trade away your money. Why? Because of the spread. Now if you want to sell the euro, you click sell. If you want to buy euro, you click buy. As simple as it appears, and you will buy euro at a certain price. Wherever you see the price at that point, please, that is where your price should be. That is where the price will be taken from. Immediately you execute a trade, the price, wherever you see those prices, the bid and the ask price, wherever you see them, that is where the price or the market will be instantly executed. And we're also going to be talking about what is pips and pipette. What is pip and pipette? Now in this section, a little math is required to calculate your profit or loss. You've probably heard of the term pips and pipettes, lot and lots more. And here we're going to explain what they are and show you how they are calculated. Now you take your time with this information as it requires knowledge for all forex traders. Don't even think of attempting about trading until you are comfortable with your pip values and calculating profit and loss. Now in this case, you don't do the calculation, you don't even think of engaging into this market if you are not comfortable with the calculation of your pip and pipette. Now let's take, for instance, here we have 1.13215, and then after some few minutes or after 1 hour you find out that this thing has turned to 1.13216. How many pip did the market move? The market moved just 1 pip. That is what it means. And then we also talk about pipette. Pipette actually explains this. Pipette explains this. How does it explain it? Now, the unit of measurement, we're going to now, what the heck is pip and what about pipette? Now, this gives a clear understanding or a clear explanation of what it's all about. Now, looking at the two also, it say the unit of measurements to express the change in value between two currencies actually called pip. Now, if Euro USD moves from, as you say, it 1.13215 to 1.13216, it's moved 1 pip. That is exactly equal to 1 pip. Now, a pip is the last decimal place of a quotation. Now, given that 4 decimal places are used for pairs without the Japanese yen, so these are actually used for pairs without Japanese yen. Now, these are the 4 decimal places, 1, 2, 3, 4. Now, when quoting or when calculating your profits or your pips, this is how you do it. Now, you say 1.1321 and not adding this, because whenever you add this, in other words, you've actually added the 5 decimal point or the 5 decimal place. That actually means that you are now calculating it in pipette value and not in pip values. So whenever you're calculating your pips, what you do is that you calculate from here 1.1321 and then you end it. So if the market moves from 1.1321 to 1.1322, it moved 1 pip. That is what it means. Same thing is applied here. Now this is determined to be pipette because in this particular pair, this pair have a Japanese yen. Now I'll read this. I will explain this again. A pip is the last decimal place of a quotation, given that 4 decimal places are used for pairs without Japanese yen. So these 4 decimal places from here are used for pairs without Japanese yen. But any pair that have the Japanese yen on it, you could actually calculate from here to this last number in order for you to get the accurate figure of what you wanted. All right, so this also is very important. Now there are brokers that quote currency pairs beyond the normal standard 4 and 2 decimal places to 5 and 3 decimal places. Now these are 3 decimal places and these are 5 decimal places. There are brokers that quote off real time, like they said they are quoting fractional pips. All those are determined to be fractional pips, also called pipettes. Now for instance, if Euro USD moves from let's say 1.51542 to 1.51543, it's moved just 1 pipette if you are to be calculating here, or if you are to be calculating and adding this 5 decimal place or 5 decimal points. And also we're also going to be talking about the next on the board. We're going to be talking about types of orders. Now the term order refers to how you will enter and exit a trade. Here we discuss the different types of orders that can be placed into the foreign exchange market. Now be sure that be sure that you know or you fully understand which type of order your broker accepts. Different brokers actually accept different types of orders. Now there are some basic order types that all brokers provide, and some orders that sounds weird. Now we have some other ones like what you see on the background here, and then sorry, we have so often we have buy stop order, we have sell stop orders, we have buy limit order, we have sell limit orders. So most of these orders say orders placed above prices. Buy stop orders are order placed above prices, and price keeps going up. Now if you look here, anyway, I was going to explain that in a plain chart using the Metal Trader 4 platform to explain this in our next tutorial. But in order to get to understand this very well, please, you might just want to subscribe to our channels, so as to get the full details of what we training you on how to we training you on how to get a better knowledge and how to make a good trading decision in this forest industry, in this forest trading industry. And also we're also going to be talking about market orders. Now what is market order? A market order is an order to buy or sell at the best available price, as simple as that. Now for example, the bid price for euro USD is currently at, let's take for instance, currently at 1.2140, and the ask price is at 1.2142. If you wanted to buy euro at market or at the market, then it would be sold to you at the ask price of 1.2142. Now you would click buy, and your trading platform would instantly execute a buy order at that exact price. So that is what it means. Just click a buy here. If you want to buy, it's a trade. So you click a buy or you click a sell, and then the trade will be instantly executed. And also we also have a limit entry orders, which are stop entry orders, we have stop loss on orders, we have take profit orders, and so and other more. Now limit entry orders, I've told you. And limit entry orders, let me just explain, make a little explanation so now it works. Limit entry orders is an order placed to either buy below the market or sell market above the market at a certain price. Now for instance, let's take euro USD is currently trading at 1.2050, and you want to go short if the price reaches 1.2070. You can either sit in front of your computer or monitor and wait for the next day, at which you would click a sell or a sell market order to set this trade ahead of time. And then when that is done, there is the market will instantly be executed. Immediately the price comes to hit the market or the limit entry order you have placed. Now let's say or you can set a sell limit order at so and so price at where you want it, and then you would walk away from your computer to do whatever else you have as your daily schedule or your daily routine. Now if the price goes from so and so price to so and so price, your trading platform will automatically execute a sell order depending on the level where this trade is being executed at the best available price. Now you use this type of entry orders when you believe prices will reverse upon hitting the price you specified. So this is how it works. Apart from this, guys, there is nothing else. We also have we also have stop loss. I think here that's stop entry orders. We have stop loss and orders. Now stop loss orders are is a type of order linked to what? A stop loss order is a type of order linked to a trade for the purpose of preventing additional losses if price goes against you. Now remember this type of order. A stop loss order remains in on effect or in effect until the position is liquidated or you cancel the stop loss order. For example, if you want to go long the Euro USD at so and so price, so tells you or explains where you're supposed to actually set this sell limit order or buy stop order or stop loss order. Now, talking about stop loss orders, now how do I set the stop loss order? The easiest way to do this is this. Now, when you're selling from the support from the resistance, your stop loss order should be above the resistance. Your stop loss order should be above the resistance. Now you are selling below the resistance levels or the resistance zone. So your stop loss should be above the resistance. And then if you are buying a trade, now what happens is that your stop loss should be below the the support levels, below the support level. If you are selling, your stop loss should be above the resistance levels. But if you are buying, your stop loss should be below the support levels. And then this is how you get most of these things done, guys. Now your trade will remain open as long as the stop loss has not gone to hit. It will either remain open in profit or better still. Okay, so also we have some other market analysis, say 3 types of market analysis online that every trader specializes, or most often some of the traders actually doesn't engage with this type of analysis. But why am I bringing this analysis to you is because this analysis actually gives you a balanced knowledge of what you're coming to do. Just think of trading with just your technical analysis knowledge, and then whatever happening with the fundamental analysis you don't know, whatever happening with the sentiment analysis you don't know, then we've gone past all that stage. So what we're doing is this. We're actually going to be showing you now to make a proper analysis on that of the technical analysis and the fundamental and then sentiment. But that's going to be on our next tutorial. But in order to get notified when these videos are uploaded, guys, please hit on that subscribe button and of the bell icon. If there be any mistake you identified on the course of this training, please just comment below and let us know, just to make a better improve, just to make a better videos and to make better projections of the courses that will be projecting to you guys. But also we're also going to be touching this technical analysis a bit. And now, what is technical analysis? Okay, let's take for instance, and to begin, let's look at 3 ways on how you would analyze and develop ideas to trade the market. Now, there are 3 basic types of market analysis, which is 1 technical analysis here, and then 2 fundamental analysis and sentiment analysis. Now, technical analysis is the framework. Technical analysis, I'm talking on technical analysis now. It says the framework in which traders study price movement. The theory is that a person can look at historical price movement and determine the current trading conditions and potential price movement. Okay, so the main evidence for using technical analysis is that theoretically all current market information is reflected in price. So if price reflects all the market information or all the information that is out there, then price actions is all one would really need to make a trade. Now, have you ever heard the old adage, history tends to repeat itself? History tends to repeat itself. This is basically technical analysis. Now, well, That's basically what technical analysis is all about. If a price level held as a key support or resistance in the past, now traders will keep an eye out for it, and based on their trading experience or on their trades around the historical price levels, typically or technical analyst looks for similar patterns like what happened previously, what happened before that particular what happened before that particular analysis, because for that particular moment you're doing your analysis. And now typically or technical analysts look for similar patterns that have formed in the past and will from it generate ideas, believing that price will act the same way it did the other day. Now, price actually have problems breaking what there's resistance and the support, and this is how you trade with using technical analysis. Technical analysis have this nature of it has everything to do with scaling up your support and resistance levels, scaling up trend lines, and some other Fibonacci retracements and all. And then in the world of trading, when someone says technical analysis, the first thing that comes to mind is a chart. Technical analysts uses charts because they are the easiest way to visualize historical data. These are the easiest way to actually analyze what's going on in the market. Now you can look at the past data to help you spot trend and patterns, which could help you find some great trading opportunities as a trader. Now what's more is that with all the traders who really on technical analysis out there, these price patterns and indicators or indicator signals tends to become self-fulfilling as more and more traders look for certain price levels and chart patterns that are more likely that these patterns will manifest themselves in the market. Now you would know though that technical analysis is very subjective, just because Timber and Sabisusu are looking at the exact same chart setup or indicators doesn't mean that they will come up with the idea of where price will be headed to. The importance of this thing or the importance of technical analysis is that you understand the concept under technical analysis, that you won't get a headache whenever somebody start talking about Fibonacci, Bollinger Band, pivot points, and for other more. And we also have fundamental analysis. Fundamental analysis is a way of looking at the market by analyzing economic, social, and political forces that affect the supply and demand of an asset. If you think about it, this makes a whole lot of sense. Just like in your economy, it is demand and supply that determines price. Using supply and demand is an indicator, or there is an indicator of where price could be headed easily. Now the hard part of analyzing all the factors that affect supply and demand, in other words, you have to look at different factors to determine whose economy performs well and whose economy is not. You have to understand the reason of why and how certain events like an increase in an unemployment affects a country's economy and ultimately the level of demand for its currency. The idea behind this type of analysis is that if a country's current or future economic outlook is good, their currency should strengthen. The better shape a country's economy is, the more foreign businesses and investors will invest in that country. This results in the need of purchase country's currencies that country's currencies to obtain those assets. And also we're going to be talking about sentiment analysis. What is sentiment analysis? Now, earlier we said that price should theoretically actually reflect all available market informations. Unfortunately for us traders, it isn't that simple. The market do not simply reflect all the informations out there because traders will just act the same way. Of course, that isn't how things works. Each trader has its own opinion and explanations of why the market is acting the way that it does. Each trader's thoughts and opinions, which are expressed through whatever position they take, helps form the overall sentiment of the market. The problem of that as traders, no matter how strongly you feel about a certain trade, you can't move the market in your favor. Even if you truly believe that the dollar is going to go up, but everyone else is bearish on it, there is nothing much you can do about it. Now, as a trader, you have to take all these into consideration. It helps to you to gauge how the market is feeling. However, it is bullish or bearish. Ultimately, it is also up to you to find out how you want to incorporate market sentiment into your trading strategy. If you choose to simply ignore market sentiment, that's your choice. But they were, but there you are telling you now, it's your loss. So doing with sentiment, fundamental and technical analysis gives a trader what is called a balanced knowledge. It gives you a balanced knowledge. That's what makes you really powerful, and not all other um or not all other um blah 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 that normally comes out from these new beginner traders and all that. Now, in conclusion, the basic order types, market limit entry orders, stop losses, trailing stops are usually all that traders ever need. Unless you are a veteran trader, don't don't worry, with practice and time you would be. Now, don't get fancy and design a system of trading requiring a large number of orders sandwiched in the market at all times. Stick with one basic stuff first. Make sure you fully understand and are comfortable with your broker's order entry system before executing a trade. Also, always check with your broker for specific order information to see if any rollover fees will be applied if a position is held longer than 1 day. Keeping your ordering rules simple is the best strategy. Now, do not trade with real accounts until you have an extremely high comfort level with the trading platform you are using and its other systems. Erroneous traders are more common than you think. So please, guys, do not think of attempting to do anything else until you are comfortable with what you have learned, until you are comfortable with making profit, probably putting the stop losses and take profits and more. But until then, I want you guys to please stay connected again. If you've not subscribed to our channel, please do well and subscribe to our channels, and so as to get we're going to actually be releasing some strategy that makes you very profitable in this forex trading market. You might just want to check on our trading platform on our YouTube channels. check on the previous trades we've made, we've actually been posting most of the live trades we make on daily basis. And that's what makes us what we are today, and that's what gives us the knowledge we are distributing to the world. All right, guys, my name is Toby again. I want to say thank you for listening. Please stay connected as we move the world's market to the next level.